Howdy, this is David Groce, your Texas Tax and Lawman, continuing our overview on the different types of LLCs. In this series, we outline the history of an LLC, the documents that comprise an LLC, and then we discuss the various forms, shapes, and tax structures in an LLC, from single-member LLCs to partnerships, corporations, S-corps, and limited partnerships. Today, let's look at an LLC as a disregarded entity. Let's discuss what disregarded means for state and legal protection and federal tax treatment. But first, let's paint a mental picture using our truck analogy. All along, we have said that LLCs were like different kinds of trucks. When we talk about an LLC disregarded entity, I want you to picture one of those slide-in campers that rides in the back of a pickup truck. Yes, it is a camper. It can stand on its own, but it has to ride on another truck to get there. So let me explain how that works. First, calling a company a disregarded entity sounds crazy. Why would you go to the trouble to create an LLC and then disregard it or ignore it, which is the plain meaning of the word disregarded? The good news is that an LLC is disregarded for tax reasons, not state legal liability protection reasons. When we create an LLC and then make it a disregarded entity for federal tax purposes, we are saying that the entity will not have to pay or file its own tax return. But for protecting you personally from a lawsuit against that entity or the business activity in that entity, a disregarded entity is just as strong and real as any other LLC. Second, the term disregarded really just means that for federal tax purposes, the LLC is not going to file its own tax return. This begs the obvious question: why would we want to do that? Well, the simplest answer is that we have an asset, like an airplane or a rent house, and we want to compartmentalize it inside its own LLC for asset protection. However, we want the real owner, either the parent corporation that owns it or the individual property owner, to report that income on their own income tax return. In our practice, we often do this for a family ranch where we want some liability protection for the activities on the ranch, but still want to file subchapter F, farm and ranch, on the personal tax return. We create an LLC for liability protection, and then for the EIN with the IRS, we elect to be a disregarded entity and report that income and loss from the farm on the individual's tax return on Schedule F. We do the same thing with rental properties and report it on Schedule E. For corporations who own toxic assets or high-risk assets, we put them in their own LLC for liability protection and then report the profit or loss on the parent company's tax return. So if you already have a big, nice truck and are thinking of adding a little something extra to your business, keep in mind the slide-in camper of the LLC world, the disregarded entity. Thanks for tuning in again. If you learned something or enjoyed this video, click like and subscribe below. Until next time, adios. Texas Tax and Lawman legal disclaimer. Hey, I'm a lawyer. You know I have to have some lawyer mumbo jumbo. This is a general information video, not client attorney privilege information. The content is information only and is not directed to any specific facts or circumstances and cannot be relied upon as a legal opinion, even though that would be nice and save you a trip to the lawyer. If you have a specific legal question, feel free to contact David Groce directly or seek qualified legal or tax counsel in your state of residence, state of mind, or whatever place you call home.